Hey everybody, it's CJ Maurer. I'm the Director of Marketing at Complete Payroll, for those of you who don't know me. And today we're doing something new and what I think is also a little bit of fun. We are going to interview what we are considering a payroll expert, a payroll and HR administrator named Grace Ferguson. And we're going to talk about the new tax bill and the potential impact that this tax bill will have on payroll professionals and employers in general. So before we begin, Grace, first of all, thank you so much for making yourself available for this. And before we kind of get into some of the questions I'd ask, could you just tell everybody a little bit about your background and your experience and why we're very excited to have you on this video today?
Sure. And thank you for having me. I started my payroll journey in 2000 working for a company called Comp Benefits Corporation as a payroll specialist. And that company is responsible, actually, they were responsible for overseeing dental offices in different states. And the employees of those dental offices were actually on our payroll. And I was responsible for paying those employees. Now, that company was later bought out by Humana. I later moved on to work for a company called Food and Gas Incorporated, and that's a petroleum distributor. They are responsible for selling oil to different gas stations, and the employees at those gas stations were on our payroll. So I was responsible for paying those employees and for also administering the company's benefits plan. I also had to work a lot with staff accountants to make sure that the payroll taxes were accurately reported and paid. In 2009, I left the workforce. And from then, I've been working as a business writer and blogger. For the past 3 years, however, I've been mainly writing about HR, payroll, and benefits administration.
Cool. Yeah. So for everybody, I happen to find that background really interesting. The Cliff Notes is, Grace was in payroll administration for a number of years, and now she just writes about it, about payroll and human capital management. So, she's really the perfect guest to talk a little bit about this topic. And so let's get right into it. The tax bill, officially the Tax Cuts and Jobs Act, or is it the Tax Cut or Cuts? I don't know. Just okay.
So Cuts and Jobs Act. You had it right.
Perfect. Okay, good. So what is in terms of its impact on employers, what is, the big picture impact? How might you explain that to somebody, at a party or in passing, where you don't want to get into all the details, but what is the easiest way for an employer to understand this bill in terms of the impact it might have on them?
I would sum it up as having a dual effect, that it affects not just employers, but it automatically ricochets onto employees as well, because both sides are seeing reductions in their tax rates, and they're also seeing changes in certain deductions. And whatever an employer does, because employees are so intricately involved in the company, it automatically affects them, especially when you're talking about the tax bill.
Yeah.
So that's the big picture.
Sure. So you mentioned how a lot of both employers and employees are going to see some significant deductions. What are the perhaps quickest and easiest ways that employers will see those deductions? How are they going to come through for them?
Well, the quickest ways in terms of, you mean taking those deductions, or in terms of how they are impacting employees?
I guess quickest isn't the best term. I guess what I'm really asking for is like, what are the maybe the simplest ways that simplest / easy to understand ways that employers can take some deductions by what was just passed in this new bill?
Okay. Well, I think the simplest ways is they're going to have to know what those deductions are. That's the first thing. So, and because we're dealing with such a comprehensive piece of legislation, they're probably the best way is to get with their financial planner or their CPA to find out exactly what deductions they're entitled to. Because take, for instance, the transportation deduction that they used to be able to claim for providing employees with transit passes or parking fees, those are gone. The only way they can take a deduction now is if they're providing transportation to ensure the employees' safety in getting to work. Another example is meals, employer provided meals. They can only take that deduction if the meal is being provided at an on-site cafeteria or eating facility, and they can only take 50% of that deduction of the costs. So they have to know exactly what's been cut, what has not been cut, and the best way to know is to get with their financial planner or their CPA if they don't want to have to pore over the details themselves.
Sure, that makes sense. Does this tax bill favor any certain type of legal business entity over another, or maybe does it depend on other factors?
I wouldn't say. Well, we do see a steeper reduction for corporations. We see that. However, they're pass-through entities, and they represent they're the largest set of companies in the United States. We have more pass-through entities than we have corporations, and they're all allowed to deduct 20% off of their gross income before even paying taxes on that income. Corporations, they're getting a steep reduction from 35% to 21%. So that works out for them. But again, like I just mentioned, pass-through entities are also getting 20% off. However, we can call it favorable, I guess. The deductions for corporations, not deductions, the reduction is permanent. However, for pass-through entities, that deduction, the 20% deduction, it expires in 2025.
Got
So yes, so that is a little imbalance there, but they do have 8 years to take that 20% deduction.
Well, that's good.
Yeah.
What are some of the things that are changing the most as a result of this tax bill?
Aside from those two things, for corporation and pass-through entities, I would say the individual tax rates. Employees are going to see, not going to see, it's actually happening right now. There's a 1 to 4% drop in most of the tax rates. For example, the highest tax bracket of 39.6% has been dropped to 37%. So there is for most tax brackets, there's a 1 to 4% reduction in the rates. Also, the personal exemptions, and this is big, that is gone. These are exemptions that employees used to claim on their W-4 forms as dependents. You take one deduction for your spouse or two for your children, for your dependents. Those personal exemptions are gone, but they have been replaced with a double up of the standard deduction. So it's kind of like a wash, where the standard deduction has been doubled from $6,000 to $12,000. But the personal exemptions, which used to be, I think, a little bit over $4,000 per person, that's gone. So those are two major things for employees: the reduction in the individual rates and the personal exemption being gone. And for employers, the deduction in the pass-through entity, the 20% that they can take, and the corporations, their rates has been slashed from 35% to 21%.
Wow, that's a pretty good comprehensive overview. Now, let me ask you: are there any things of note that are staying the same? That's worth paying attention to.
Yes, two things, in my opinion, that I believe they're more significant than anything else to employers in terms of changes, and that is pre-tax contribution limits. If you have a 401k plan, a traditional 401k, before the law was passed, there used to be some talks about the pre-tax contribution limits being slashed to $2,400. However, the bill did not touch that at all. So now employees with a traditional 401k can put aside up to $18,500 in pre-tax money in their traditional 401k. The second thing that has stayed the same is the Affordable Care Act for employers, because we know the individual mandate has been repealed effective 2019. However, for employers, nothing has changed. Employers are still going to need to provide, if they're applicable at large employers, they're still going to need to provide minimum essential coverage that's affordable and that meets the minimum essential coverage. They're still going to have to make sure that the different versions of forms 1094 and 1095 are accurately filled out, that employers are receiving their form on time. So pre-tax 401k contributions and the Affordable Care Act, those are the two biggies that have stayed the same for employers.
Thank you. That's good to know. I think a lot of people are going to be glad that that you just cleared that up. What has employers excited about this new tax bill?
When I answer this question, you're going to hear me allude to employees a lot, and that is because employers and employees have a mutualistic relationship where one depends on the other for their success. When employees are happy, the business thrives. So I believe that what has some employers happy is what it automatically affects employees as well. Now, some employers are happy, the corporate employers, because they're getting that reduction from the 35% to 21%. It will allow them to provide higher wages, better bonuses for their employees. Now, not all employers are thinking like that, but there are some employers who understand that this is a mutualistic relationship here. So our company will thrive if our employees are happy. So they're glad that they're getting this reduction, sure, so that they can compensate their employees accordingly. Other employees, other companies as well, pass-through entities, they can do the same thing with that 20% deduction that they're able to take. They can offer better rewards programs to make their employees more productive. And the final thing that I think some employers are happy about is that they are now allowed to take a credit of a minimum credit of 12.5% if they offer paid FMLA leave to their full-time workers, or a proportionate amount if they're offering that paid leave to part-time workers. Now, this is big because, as we know, the Family Medical Leave Act offers unpaid job protective leave. So if an employer wants their employees to stick around after going on leave, and they have to come out of pocket to pay them paid leave, if they feel that's something that's important to the employee.
Right.
So the fact that this is allowing employers to take a credit, a minimum of 12.5%, and that percentage goes up based on the amount that's being paid to the employee. So it's a win-win. Employers have an incentive to provide paid leave to under the FMLA, and not just that, but employees who are seeking great benefits will be very happy about that.
Yeah, that'll be interesting to see how that plays out, especially in a state like New York, which, as you know, just effective January 1st of this year, its new Paid Family Leave Act just became effective. That was passed actually back in 2016, along with a new wave of minimum wage increases. So that's started officially January 1. So New York joins, New Jersey and California and a couple of other states that have, mandated paid family leave. So that'll be interesting to see how that plays out. Now, let me ask you, when you were back in payroll and HR administration, how would you be thinking about this? And I guess another way to rephrase the question is, what is the impact of this tax bill on payroll and HR administrators? How might it change their day-to-day job?
The impact is that it's the timing. I think that's more than anything else, that the timing of this new tax bill is the biggest thing for HR and payroll administrators. It's coming at a time when it's smack dab in the middle of W-2 processing, year-end processing, and that is the most hectic time for a payroll and HR for those two functions. it's overwhelming because of that. They already have to make sure that W-2s are going out on time, that they're accurate, and not only that, that their 941s or their FUTA forms, all of these different tax forms are being reported on time, accurately to the federal government, state, and depending on where they're located, local governments. So the timing, I think, is the biggest issue here for those professionals.
Yeah, for sure. We have a lot of people at our organization that would definitely relate to that, and we'll be very glad that you brought that up.
Yeah.
Same thing with our clients too. So you mentioned some stuff about employees and the impact that it has on them, and specifically the impact that it has on employers as a result of the impact that it has on employees, right? Like, and the reciprocity that really exists. But before we wrap up, what about employees? Is there anything else that you think that is especially relevant to them about this new tax bill?
Yes. Employees are mainly concerned with two. What I've found is that employees are mainly concerned with two.
Happens to the best of
Sorry,
us.
CJ.
That's okay. Keep going. No, you're fine.
Okay. What I found is that they're mainly concerned with two things with this tax bill. How is this going to affect my paycheck? And how is this going to affect my taxes when it's time for me to file? What is my tax liability going to be like? Those are the main things that most employees are concerned about. And I think what they have to realize is that they need to be proactive and not simply rely on their employer to give them all the information that they need. Now, I want to circle back just a little bit to the prior question that you had about how this was impacting HR and payroll administrators, because it kind of ties into this. I wanted to say that one of the things that HR and payroll administrators want to do is to make sure that they're managing employees' expectations, because our Treasury Secretary told us that 90% of employees or individuals will see an increase in their take-home pay. Now, that may very well be true. However, it's very important for HR and payroll specialists to explain to employees that that increase is not automatic. It's dependent on how you fill out your W-4 form. It's also dependent on your taxable wages, your filing status, and the IRS withholding calculators. They've got to manage employees' expectations because they're coming in thinking, oh, I'm going to be in that bunch getting an increase. It's not automatic. So I'm going to go back to your last question. Employees have to be proactive in making sure that their W-4 forms are filled out the way it should be filled out. Now, the 2018 form has not been released yet, but we know it's coming. So it's up to employees to examine the first paycheck that they receive in February showing these changes. Look at it and decide whether they need to adjust their 2017 form in the meantime. And if they need to adjust the 2018 form later on, if they may need to do that. They need to be proactive in also going on the IRS's website and using the calculator to help them figure out what their taxes should be so they don't underpay and overpay. They can expect their employers to tell them that this change is here. They can expect their employers to tell them that you may need to fill out a new W-4 form. But they can't expect their employers to show them how to fill out the form so their taxes are accurate. And they can't expect their employers to tell them they even need to fill out a new form because that's their job. So I think it's very important that their expectations are managed and that they are proactive.
I think that's a phenomenal answer that resonates probably with a lot of people in our industry out there. Grace, I want to thank you so much for your time. Everybody, this is Grace Ferguson. She is a former payroll and HR administrator and a current writer and content producer in the payroll and human capital management field out of Atlanta, Georgia. She's added a ton of value for me and us already, and I hope you all feel the same. So, Grace, thank you so much, and we look forward to catching up with you soon.
Okay, thank you, CJ.
Take care.
All right, you too.